So by way of background, my name is Thanasi Skopidis. I'm one of the co-founders of Suppli. I have my business partner on as well, Ryan Ayers,
Hey everyone.
who's also here. I'm gonna start sharing my screen because we put together a presentation for you all regarding a pretty topical topic, which is obviously credit card fees and the impact they have on all of construction suppliers' bottom line. So let me share my screen now. So I imagine you guys can see my screen. Is that right?
We can.
Awesome. Okay. So let me get started. I guess by way of background, obviously we'll start by introducing a little bit about who we are. We are a mission-driven business. Put simply in one sentence, our mission is to empower independent suppliers to compete with the large national brands and really to deliver an awesome customer experience. And so what that means, just a few little tidbits about some of the solutions we offer, things like customer portal to increase customer loyalty, things like technology to reduce payment processing fees and increase margins, tools to get you guys paid faster, and then productivity features to make sure that you're able to grow your business without necessarily having to, grow your headcount. And so just a few little snapshots of some of the things we do. Obviously to that customer portal, a lot of guys offer customer portal. We're not the only ones, but we take it a step further by really making it uniquely oriented for your contractor customer base. So that means mobile payments, a fully mobile responsive layout, things organized by job, also in terms of communication tools, allowing you guys to communicate with your customers via text. Because a lot of these smaller guys, as I'm sure you know, really live and die by their cell phone, particularly text. Email these days have gotten so cluttered that it's really not an appropriate venue, particularly when you're trying to get paid quickly. And last things, other things like authorizations, deposits, and other unique features. So they're really applicable to the space. And just a little bit, this is our contact information. If anyone has any questions, you're obviously more than welcome to write them in the chat. Also, if you don't feel comfortable writing in the chat, feel free to email them over to Ryan. His email can be found on the right of the screen, and he'll be sure to read them out. But we want to make this as interactive as possible. So, please don't be shy. Ask as many questions as you'd like. And here's today's agenda. So we will start with just an overview of card usage. I'm sure this is something all of you know well. But over the past 10 years, credit card usage and card usage has really skyrocketed at particularly the detriment of check payments. I think this is a result of a couple different things. One is just ease and convenience. Cards are just significantly easier to use. And checks, as I'm sure many of you know, there's a lot involved with that. It's not just writing a check. It's a lot of these guys, they may not have a fully automated AP system. That means going to the mail, doing a lot of different things that, it takes a lot of time. Right. And I think what's more interesting, right, and I think this really took off post-COVID, is just the number of payments that are taking place remote versus in person. It's really honestly almost doubled since 2015, from 20% to 36%. And we continue to see that trend to increase as more and more technology gains traction and just makes remote sort of transactions much more prevalent. And so what this means, right, with this backdrop, it does mean more fees for suppliers as more and more people transition to remote payments as well as card payments. And again, this is kind of to my point a second ago, really what's driving this is the card networks have done a very, very good job at incentivizing credit card usage. As I'm sure many of you guys probably have or know of people that have, a lot of these cards offer pretty extensive and expansive cash back. Probably 10 years ago, cash back was very small and limited to a subset of transactions. These days, you're seeing the likes of Capital One, with unlimited 2% cash back, right? And so it's a huge incentive for a lot of these businesses, particularly these businesses that are running, pretty large expense accounts to use those cards to get that big cash back reward, right? I think another thing that's also driving this is particularly the remote payments is just with the technology and the integrations that are taking place, things like Capital One business cards, Amex business cards are now linking with a lot of the software that a lot of your customers use, like QuickBooks. So, they'll be able to automate and close out their accounts on a monthly basis much quicker when they have all that detail integrated from their card usage, expense line items written out, et cetera, in an automated fashion, which again just incentivizes card usage. And all of this is by design. These card companies know that the more people use their cards, the more they're going to make. And so they've spent a huge amount of money, resources, marketing, et cetera, making sure that their cards are as easy and useful to use as possible. So what does this expense look like? It's the top 5 opinion when it comes to these suppliers, particularly as a percentage of revenue. Most of the suppliers we deal with are taking at least a third card and assuming a 3% interchange rate that really comes out to 1% of your sales you're losing to card interchange fees, right? And so for what we've done on the right-hand side, right, is put a chart to really quantify what this looks like on an annualized basis. So for some of your smaller suppliers doing $20 to $25 million a year in sales, we're talking about multiple people from a headcount perspective. Investments in equipment, investments in marketing, advertising, a distribution to the owners, for example. So it's a very, very material cost. And then, it wouldn't be appropriate to really focus on the credit cards without trying to understand the makeup of the fees. We do this and we talk to merchants all the time, suppliers, about credit card usage. And I think there's a lot of misinformation in the marketplace in terms of how card fees work, what's negotiable, what's non-negotiable. And then when you go online, it's very hard to realize, what is true, what is not true, et cetera. And so on this page, we really tried to break down the anatomy of a swipe, right? And there's really 3 components to every transaction. The largest component, typically, 75% of the fee is the interchange fee. And so what is this interchange fee? One, it varies by card. So the interchange fee for a debit card, for example, is different than the interchange fee for a credit card, a prepaid card. And even among credit cards, the interchange fee can vary. So a Visa Signature Preferred card will have a different sort of interchange rate than an Amex Black card, for example. And so what's important is that these interchange fees are non-negotiable. That means no matter what kind of relationship you have with your processor or your salesperson at the processor, they can't negotiate it. It is written twice a year via all of the major networks. For example, if you wanted to learn about the different types of interchange fees, you could go on Visa's website right now. You type in Google Visa interchange, and you'd get a PDF breaking out every single card and what the interchange fee looks like. On top of these interchange fees, which again are levied by the issuing banks, there are the card network fees. Now, the network fees are also non-negotiable, and they are in addition to the costs that are paid to the actual issuers of capital, i.e., JP Morgan Chase, Capital One. So these are the fees you're actually paying to Visa, MasterCard, Discover, American Express. These fees, again, are non-negotiable, and they represent probably the second highest component of the fee. And, obviously, or naturally, unfortunately, the only fee that is negotiable is known as the processing markup. So when you're talking to your merchant services provider, there is negotiating room. It is this processing markup. It's otherwise known as an acquirer's fee, for example. This is charged by the likes of First Data, which goes under the name of Card Connect in the marketplace, or Global Payments, et cetera. And these fees, typically range from 25 basis points or 2.25% all the way to 1%. We've kind of put the middle here, the smallest component, but this is really where you can negotiate and get flexibility. So, again, all in, long story short, the vast majorities of fees are non-negotiable. A small component is. So you're probably asking yourself, well, if there's nothing to negotiate, what exactly can we do, right? And so again, going on to the previous slide, this is just a graphic and some tables that really kind of highlight, some of the information you could find on the internet, particularly if you went, the graphics on the right were pulled directly from Visa, MasterCard, and American Express. Again, this is publicly known information. I will highlight with American Express, for some of the smaller suppliers out there, that qualify. So by small, we mean taking less than $1 million a year in American Express. You do qualify for what's known as the OptBlue network, which means that you can get off-the-shelf rates. For bigger suppliers or people taking more than $1 million a year in Amex, you probably know that you get a separate Amex statement. And with that separate Amex statement, that means that you're typically negotiating these Amex rates directly. That being said, I mean, if you are an Amex Direct merchant, we would definitely advise at least going on to see what the OptBlue rates, because at the very least you shouldn't be punished for doing more volume. You should have a rate that is at or below what's represented on the OptBlue. And on the left-hand side, again, it's just a graphic. It's pretty simple, honestly, when you think about it. It's basically the less risk there is with a card, the cheaper it is to process. So less risk means a debit card. That means the cash is in the account. There's no issuing of capital, essentially. And so interchange rates can be as low as 5 basis points or 0.05%. The more expensive cards are going to be those business or commercial cards, which frankly are what we see typically taking place in the industry we're talking about today, which is the construction side. A lot of your contractors probably aren't using a debit card for a $50,000 or $20,000 purchase. They're probably using a high limit commercial card. And so that's where you're going to get the higher interchange rates. And then on top of that, again, going back to less risk versus more risk, basically card present transactions are considered less risk. So that is an in-person payment. So those are going to have a typically lower interchange rate than card not present over the phone sort of transactions, which with high ticket. We're going to get into this in a few minutes here, but there are some things around interchange optimization where you can probably see on the slide we have things like level 2, level 3 commercial cards. By upgrading or providing more information, you can actually transition a lot of those card not present or reduce the interchange rates of a lot of those card not present transactions to a lower rate. And so, as I'm sure many of you know, you do get a statement at the end of the month, most typically from your merchant processor. It is probably a difficult thing to understand. I think it's typically by design. There's not a lot of transparency. There's a lot of terms which are hard to understand. We typically see them broken out between, interchange fees, processing fees, service fees. And so it's really hard to know, what is the negotiable component here and what is the non-negotiable component. But, from a high level, there are really 3 different pricing models we typically see. I'll start with the top. In our opinion, this is probably the most transparent pricing model. It's interchange plus. Obviously, everyone here, works in construction and is probably familiar with a cost plus concept, i.e., I'm going to charge you for the cost of materials plus a 10% markup, right? And that is what interchange plus is in its simplest, form. It is a fixed markup on the interchange rates. So, again, going back to the graphic a few slides ago, if your interchange rate was 2.5%, including, the card brand fees, a markup of 0.25% would mean your effective rate is 2.75%. The pros of this option or this pricing model are that it is typically the cheapest and is 100% transparent. The cons are it can vary month to month, right? Because the cards you're accepting vary month to month. They vary from transaction to transaction. And so a lot of complaints we hear from merchants is, well, why is my processing rate changing from month to month? Why is it higher this month versus last month? And with Interchange Plus, that can happen, again, because it's a cost plus model. If your interchange or your cost, right, your wholesale cost went up from one month to the other, it's only natural that your total rate is going to go up. But again, these interchange rates are non-negotiable. And so, unfortunately, if you're 1 month accepting higher interchange cards than the previous month, it's just, kind of unfortunately the cost of doing business. Now, the second model, which has kind of declined in popularity, but it's popular with certain merchant service providers, Elevon in particular is one we've seen this pretty popular with, is called tiered pricing. Essentially what tiered pricing is you essentially have categories of fixed rates. So it might say, qualified debit 1%, not qualified debit 2%, or, something along those lines, right? Or qualified tier 1, qualified tier 2, non-qualified. Essentially what's happening here is the processor is lumping in various card categories into tiers. So they might say, okay, well, all debit cards that are regulated are going to fit into qualified. All debit cards that are non-regulated are going to fit in non-qualified. And all low rewards Visa cards are going to fit into one category, and so on, right? And unfortunately, this pricing model has essentially zero transparency. It's totally at the discretion of the merchant services provider. So for an example, right, let's say a debit regulated has an interchange of 0.05%, and they put you in a 1% fee category. They're essentially making an almost 1% markup on every transaction, right? And it's very hard to figure out why that is. So we definitely do not advocate for this pricing model. You'll know you have this pricing model, again, if you go on your statement and you start seeing things like tier 1, tier 2, tier 3, non-qualified. And the last one, which is the simplest, pretty self-explanatory, is just a flat rate. Imagine you're bidding a project or bidding a job. Hey, it's going to cost you $50,000 for this, regardless of what my costs are. Very similar concept here. It typically is the most expensive option. Again, you are paying for that certainty of price. If someone's going to price you at 3%, they know that they're going to make a decent amount of money and that your interchange rates are never really going to squeeze their margins, right? So, the pros you get here are, it's very simple. It's pretty easy to understand. The cons are obviously it's very expensive, and you don't really get a sense of actually what the margin is you're paying on top of the interchange rates. I'll stop there if there are any questions, and then we'll give it a few seconds. I don't know if there are any questions, but then can kind of dive into I'm sure what is probably the most interesting kind of section of the conversation today, which is, okay, well, you told us all this kind of bad news, right? So what can we actually do about it? But I'll pause here if there's any questions. Okay, so hearing none, I will, and again, feel free, again, I know some people are shy, so feel free to shoot over any emails over to Ryan if you don't want to put it in the group chat. But I'll start with probably, the biggest piece for today's discussion, which is, okay, these interchange rates, 80% of them are non-negotiable. So what can we do, right? What can we do to actually offset this fee that is hundreds of thousands, if not millions of dollars a year in bottom line, pure profit that we're losing? And so there are really four options. Essentially, all achieve the same thing, right? And there's some nuance, and it's largely for legal reasons or compliance reasons, but they all achieve the same thing, which is passing on a portion or all of the card fee to your customer or the person making the purchase. The first, which is the most popular in this space, is a convenience fee. As the name suggests, this fee is only applicable if you are offering a convenient way of payment, right? So if you are only an e-commerce solution, right? If you're an e-commerce website, you cannot charge a convenience fee because that's the only way you take payment. It's not like there's an alternative, less convenient form of payment that you can justify. That being said, if you're a building material supplier, you probably have a branch and you probably have an option for your customers to pay other than online, right? That can be via check, that can be in person, through the mail, etc. And so you are able to pass on a convenience fee for offering a payment portal. And so that can be a huge win. And what's really nice about the convenience fee option is you are not subject to the state-by-state regulations that we often hear, when talking about a surcharge, right? So certain states like Connecticut, for example, they prohibit things like a surcharge. There are other rules related to a surcharge that I'll get into in a second. But for example, you cannot apply a surcharge to a debit card. So the main difference between a surcharge and a convenience fee is that a surcharge is not passed on for the convenience of making payment online. It is essentially saying we are going to charge you money because we are, we don't want to eat the cost of eating credit cards. Again, achieving the same concept, but there are details that make one compliant and one less compliant. The other two, which are a lot less popular, but you may have seen in a retail environment, are known as cash discount and non-cash adjustment. Again, they're kind of two sides of the same coin. With cash discount, essentially, it's like you have two sets of prices. We have a popular retail chain here in Texas that it's when you go to the store, you'll see one set of prices. It's 100, and it will say if paying by cash, 97, right? Vice versa for non-cash adjustment, where it might say if you're paying cash, it's 100. If you're paying with card, it's 103, right? Again, same thing, not really common in this space, but just wanted to flag it because it is two additional options that are available. And so what do these savings look like? Again, for us, we only deal in this space. For us, it's been a huge win for a lot of our customers. I'm talking about on average $1 million a year in savings for suppliers that implement this. And that's pure profit. That's net of our cost, net of implementing our software. $1 million a year in savings. And again, this is just driven by the fact that these fees are such a large percentage of revenue, and so many of these contractors are deciding to utilize cards for purchases. Now, compliance is a big deal in this space. There are really to be concerned or to take into consideration when passing on these fees to your customers. One is, actual legal consideration. So these are passed by actually governing bodies. State legislatures are really the ones. This isn't a federal issue. This is a state-by-state issue. So there are things you need to take into consideration depending on the state you're in. Again, surcharging is one pricing mechanism where you are allowed to pass the fee on, but it is prohibited in certain states. Again, there is a list online of which states that is, but Connecticut is one that comes top of mind. I believe Oklahoma may be another one where it is illegal to pass on pass on card fees as it currently stands. In Texas, for example, there's a little bit of uncertainty. They tried to pass it, but it's kind of in limbo. So it's not prohibited, but it's also not allowed. So it's a little bit of a state in limbo. But again, it's a very gray area. But in certain states, it's pretty black and white. Again, Connecticut, Oklahoma, et cetera. Another thing to take into consideration is you cannot pass on surcharging to debit cards. That is a big no-no. So if someone's paying by debit card, you are not allowed to pass that on. A good anecdote is probably none of you could go to Builders First Source website to make a payment, but if you do go to Builders First Source website, you will see that they do not even allow debit cards in their payment portal. And the reason for that is because they are using a surcharge program, and they don't want to have to deal with trying to figure out if this is a debit card or this is a credit card. And so they said, hey, if you're paying by debit card, do not use the portal because we're charging a surcharge. Going to the convenience fee, again, it is imperative that if you are going to charge a convenience fee, you do offer an alternative payment method, a free alternative payment method. And on top of that, if you are using a convenience fee, it is imperative that you are using a convenient platform, right? So you can't just, again, going back to my previous statement, you can't just charge it because you want to charge it. There has to be a convenient reason for offering it, right? So again, that comes down to the customer portal or having some sort of online method of payment, qualifies for that. A couple other things which obviously may seem obvious are you need to display it. You can't just charge the customer and tell them after the fact, hey, by the way, we charge you a 4% fee or 3.99% fee. A big one that we come across a lot in this space is just uniformity. The card brands are the ones in charge. They have their own set of rules, right? It's like a self-regulated body. They do not want people picking and choosing who they pass the convenience fee onto, right? So if you have your top 5 customers that always pay on time and you don't want to charge them, but you have your bad customers or your customers that are less creditworthy and you want to charge them, it's unfortunately not allowed. Again, there are ways around that, which we'll discuss, in a few slides. But by and large, again, it's just about uniformity and fairness. A couple other things, the fee cannot be greater than 3.99%, so really capped at 4%. And merchants are not supposed to be making a profit on their processing fees, right? So if your interchange rate is 2% and you're passing on a 3.99% fee, essentially making a 2% profit, that is against the card rules, right? So you really should be setting the fee, at or slightly above kind of your interchange rates to be making a de minimis profit, if any at all. So what does it mean if I don't do any of this, right? First of all, it can be being blacklisted. I mean, we've come across merchants that have been on a blacklist. So that basically means that MasterCard, Visa, Discover, and Amex, they keep lists of merchants who are deemed to have been not in compliance. They're not going to put you on this list day one, but what will happen is, they'll send you a letter They'll ask you to, correct what you're doing. If it continues, ultimately you'll be put on the blacklist, which essentially means that you'll be prohibited from accepting that car brand's cards. Again, going back to, about the uniformity, right? And how do we create a program that at least incentivizes good behavior, right? I think something that's pretty unique about our system and our solution is we spend a lot of time thinking about this, just given how big of a cost it is to suppliers. And one of the nice things is that we actually do have a feature that allows you to reward good behavior and not necessarily reward bad behavior, right? And that is what we call an invoice, setting a convenience fee based on the due date of an invoice. So a lot of suppliers, they may be okay eating the credit card fee if a contractor or a purchaser, a customer, right, is going to make a payment on time or early, right? Because at the end of the day, they're paying you on time, they're paying you early. Okay, maybe this is just, I'm happy to eat the fee in that scenario. What can be quite frustrating and quite expensive, obviously, is if you have a customer that's dragging you out 30 days past due, 60 days past due, and then they're coming along and trying to pay with a credit card, right? Because not only are you having to then, float the working capital, you're then also having to eat a pretty large fee, which can actually turn into a huge cost of capital, right? And so on this slide, we really lay out what this looks like from a cost perspective. And essentially, taking into, like, this is just an example of a 60-day payment, right? Let's say someone's going to pay 60 days, right? Which is actually the average DSO in our industry. You're essentially looking at a 34% annualized cost of interest. That is extremely high, right? That's subprime lending. I'm sure when you guys go to your bank or get your working capital facility, you're looking at high single digits, right? So that is, almost 5 times higher. And the components of this are obviously your cost of capital, right? Which, by the way, has only gone up because, with treasury rates or interest rates where they are, your cost of capital might have been for a working capital facility 4% 2 years ago, is probably in the high single digits now. So your cost of capital has gone up. The credit card fees, right? Again, it's 3% per swipe. And then you've lost probably an early payment discount with your upstream provider. Many of our customers are distributors. They pay a manufacturer or a wholesaler. They might have an early payment discount. So you're talking about a 5.67% interest rate for 60 days, which on an annualized basis is, close to 34%. So it's a very real number. So, a lot of suppliers, sometimes they're a little reluctant or hesitant when it comes to rolling out a convenience fee. I get it. If it's a change from the status quo, obviously the first and most important thing is customer communication. We don't recommend just one day flipping a switch and saying, hey, we're going to turn a convenience fee now, and too bad, so sad, right? Obviously nobody wants to lose risking customers. This is a relationship-driven business. Oftentimes these customers have been formed over a very long period of time, right? And so the first most important thing is customer communication, leaving, at least a month or so before implementing, really getting the whole team on board, right? And really figuring out a way to message it such that it's to the benefit of the customer, right? And again, nobody wants to be charged a surcharge, but if you tell the customer, hey, this is really to allow us to offer you a better price, right? So, because, ultimately your fees are eating into our margins, we're able to offer you a better price. By the way, you're still able to pay us for free, right? And we are now offering a free and seamless form of ACH payment. And so, again, it comes down to customer communication, having the sales team, having the credit managers, have everyone communicate to the customer, whether they call for an order or sending out an email or a set of emails. It comes down to communicating, hey, this is for you, so we can protect your margins and not have to increase the cost. And by the way, we are offering a free form of payment. Something that's very important is making it systematic, getting rid of the human emotion element. Oftentimes what we'll see people roll it out, but if someone calls over the phone, what will happen is a salesperson might say, oh, I've known this guy for so long, I'll waive it to you in this circumstance. And ultimately it's just a slippery slope and it starts to defeat the purpose. And to make it systematic requires the use of some sort of technology, right? Where, for example, in our system, the customer portal says, if you're paying by card, it's a 3%. It's really hard to argue with technology or software, right? It's not like they're gonna look at it and they can't argue with it, right? It is what it is. Versus when you call the salesperson and you have a human on the other line, It's a lot easier to say, hey, do you mind waiving this? And then most importantly, just benchmark the competition in your area, right? Again, if we know a lot of dealers and suppliers where, they might say, hey, you know, Builders First Source, for example, they charge a 3.5% fee. So we don't really want to go above that because, we risk losing business to Builders First Source. So really just understand the competition. Are they charging fees? If so, what does that fee look like? Obviously you don't want to be twice as expensive as the fee that someone else is passing on. So just a quick set of rules, pretty simple before rolling out a convenience fee program. And then, we understand that some suppliers in some markets, might not want to charge a convenience fee. They might not want to, change the status quo with their customer. And so another concept, which is pretty helpful, is known as interchange optimization. So as the name suggests, interchange optimization is the process of reducing your interchange rates by optimizing the data that is passed on to the card issuers and card networks. So, as you may remember, the interchange rates are non-negotiable. So it's not like you can call your merchant service provider and say, hey, can you lower these rates? And so really the only way to lower them is through the use of technology. As I mentioned, ultimately, the card networks and card issuers are looking to incentivize less risky payments. And from their perspective, the more information you have on the transaction, the more controlled of an environment it is, the lower rate you're going to qualify for. And this interchange optimization concept is actually the most useful in the B2B environment. And that's because a lot of times, a lot of your customers are paying by commercial or business card. And with these commercial or business cards, as you can see, there's a snapshot on the right for different levels. There are different levels of transactions, right? And so, a level 2 transaction might just have an address associated with it. But a level 3 transaction will have an address, a PO, a shipping address, sales tax, and a bunch of other information associated with it. And so for passing all that information, the card networks are saying, hey, this is obviously a bona fide transaction. There's an invoice associated with it. The merchant is gathering all this information, and so we're willing to give them a lower interchange rate. And so as you can see, this can be pretty significant, right? We're talking over 0.5% without having to really do anything. Again, all you have to do is implement technology to take advantage of this, but you don't have to change your processes. You don't have to pass on a convenience fee to your customer, and you're able to save, upwards of 0.5% per transaction. So we're talking potentially hundreds of thousands of dollars in savings for some of the larger suppliers out there. Again, just kind of, this is a nice little graphic we put together from one of our partners that really highlights what we mean by level 1, level 2, and level 3. So level 1 is the most basic. Think about when you make a purchase online and all you do is you enter in your credit card information and potentially a zip code, right? It's very, very limited, right? Level 2 is a little bit more data, right? So it, things like sales tax, customer code, i.e. a customer ID, the postal code of where you're located. Again, just pushing more data to get a higher level of fidelity with the transaction. And then last and foremost, this is the highest level is level 3, right? And this is where, you can really start to utilize technology that is integrated with your ERP, integrated with your invoice activity to start passing on information that's embedded within those invoices. Things like the price per the price per unit, the quantity, the product description, et cetera. And that's, again, where you're starting to see that 0.5% savings per transaction. Again, now we'll move on to ACH payments because, ultimately, this is where you're going to get the most savings by moving customers away from credit cards into ACH. I'm sure many of you know that. I'm sure many of you might take ACH payments today. But one of the reasons, as we highlighted in a previous slide, that ACH payments have not taken off as much as credit card payments is because a lot of times merchants make it very, very difficult to pay via ACH. And so just an overview of what ACH payments are, for those of you that aren't familiar, think of it as an e-check. It's a digital check, same concept. It's just basically a bank-to-bank transaction. It's pretty common in the B2B world, particularly for those larger purchase transactions. I'm sure many of you get ACH payments today. Again, from a cost perspective, it's significantly cheaper than accepting credit cards. Obviously there are some cons to it. It does take longer. Many of these with the credit card, you're typically talking about next day settlement. With ACH payments, you're talking about 2 to 5 business days for settlement, which means that there is that period of time where you don't necessarily know whether or not the transaction is valid. Another issue we see a lot of times with ACH, particularly with merchants that don't have a customer portal and send out their remittance information via email, is you do make your customer susceptible to phishing. We actually talked to a lumber yard a few months ago in the Northeast that essentially someone had sent an email to one of their customers. They had the exact same domain name in the email, the same signature. And they said, hey, going forward, could you please send your ACH payments to this remittance information? Obviously that information was to a false or a different bank account that was unrelated to the supplier. It was actually a $50,000 payment. And this supplier ultimately had to split the cost of that. So 20 points, right? Because, they had a relationship and they said, hey, ultimately it's not our fault. We didn't make the payment, but, we kind of feel bad and we kind of share the responsibility here. And so they ended up, eating a $25,000 cost. So it's a pretty common thing. Unfortunately, it's only getting more popular and more common. But again, just wanted to flag. Again, going on to the thing I mentioned just a second ago in terms of making ACH payments, I'm going to click on this video just to really show you what we mean by that, right? And so on the left-hand side of my screen is a payment page from a different supplier that's not using our solution. And this is what they have on their website, right? So they check the box with having something on their website, but it's a long form that takes minutes to fill out. It doesn't have the remittance information. You have to provide it yourself. On the right-hand side is just an example of our solution. And you'll kind of see as we go through it, what the difference looks like. So again, on the left-hand side, this is someone, typing on their phone all the information. On the right-hand side, this is someone that's actually paying. In this example, it's card, but it's the exact same process for ACH, paying via ACH. Again, on the right-hand side, we're done. We're on the left-hand side. They haven't even gotten to the invoice information yet. They haven't even entered the bank account information or checking information. Whereas on the right-hand side, using Suppli, they're actually able to complete the whole process. And it's just those small things that actually drive ACH payments. Again, nobody wants to spend the time to fill out a form to make a payment, right? A lot of your contractors are in the field, they're on the job site. They don't have the time to do that, right? And so that's why they pay by card, because you probably have a card on file. It takes seconds to read a card information, and it's much harder to get your ACH or your routing or your bank account information. So making it super seamless and frictionless is really imperative, right? And so, with our solution, for example, we've seen ACH payments really take off versus, credit card payments, with those suppliers that don't necessarily offer a really simple way to do it. Kind of wrapping up, again, something we offer for a lot of the suppliers and all the attendees today is a complimentary and comprehensive savings analysis. So obviously, a lot of you guys may not have the expertise to fully understand what you are paying on a month-to-month basis. Again, what is negotiable, what is non-negotiable. We're more than happy to take a look at that for you guys, really break down, hey, this is where you're being overcharged, or this is fair, this is unfair. To do that, all you have to do is send, 1 to 2 months of statements. I've included an email to Ryan below. Again, that will obviously stay with us. We do this all the time. We can able to benchmark versus, what the average supplier pays from an interchange rate perspective, so you can get a sense of, hey, am I above the average? Am I below the average? So it's just super helpful, and super complimentary. It takes us seconds. Again, all you have to do is send an email. And last thing, I'll just wrap up, kind of how we help suppliers. Again, it just comes down to, you guys are in a relationship business. We fully understand that. So, how do we allow you guys to foster that relationship, make that relationship stronger? We were at a roofing conference a few weeks ago in Dallas. And what we found really surprising was, every morning the roofing conference put out a publication for all the attendees, right? It was a little brochure, and there were advertisements in that brochure from the different exhibitors, right? And the big exhibitors, the SRSs, the beacons of the world, they didn't exhibit, or they didn't advertise the products they were selling, right? what they advertised was their customer portals and the technology and essentially how they were implementing technology to make their customers' lives easier, right? And so if those guys are doing it, it's only a matter of time before the independents have to do it to compete, right? And again, that's kind of why we built our solution, is to allow you guys to compete with these huge companies that, you know, obviously have more resources and teams of engineers. And on top of that, it just comes down to saving money, right? You know, how are we able to help you guys save money? We understand it's a margin-driven business. And so how can we use technology to increase your margins? You know, again, how do we get you guys paid faster? We have communication tools, automation tools. These are tools that a lot of other industries use. They're proven. You know, again, average DSOs in this industry are 60 days. With our solution, you know, again, not even looking at other things, just using automation, things like reminders, right? I mean, how many of you guys, you know, get reminders in your everyday lives to pay invoices for things like, you know, if you have a pool, your pool guy, or, you know, your electric bill? You know, it's things like automated reminders, because these guys, I promise you, are not dying to pay your invoices. They're not thinking about that all the time. So you got to remind them. And again, labor is a huge issue in this industry. I think something we've noticed is a lot of people in the credit manager role, in particular the cash application role, are getting older, and you know it's going to be harder and harder to replace those people. And so if you're looking to grow your business, it's really imperative that you think about using technology so that you're able to grow without necessarily having to grow headcount. And with that, I will open it up into any questions. Again, want to make sure everyone has the time to ask a question. And so, yeah. Any questions? Don't be shy. Well, I'm going to assume that we did such a good job that there are no questions. So we appreciate everyone's time this morning or this afternoon, based on where you are. We will have a recording of this webinar. We will shoot it around after. You know, have a great rest of your week and a great weekend. And again, if you have any questions, please don't hesitate to reach out to us.
Thanks, everybody.
Bye.